Welcome, everyone. This is the first episode of The Horizon, a new podcast to help investors understand what's really going on with real estate investing. I'm excited to be part of the Best Ever CRE show, and I want to welcome all of the best ever listeners. I'm your host, John Chang. I've been active in real estate investing most of my life, and since 2007, I've led Marcus and Millichap's commercial real estate research services team. For those of you who aren't familiar with Marcus & Millichap, it's a commercial real estate brokerage that helps more investors buy, sell, and finance more commercial real estate property than any other firm. Now, I want to mention that I'm doing this podcast separately from my role as the head of Marcus & Millichap Research. So remember, the thoughts I share here are my own and do not reflect the opinions or positions of Marcus & Millichap. With that said, really the idea behind this thing, why have another podcast? I mean, there's a bazillion of them out there. I just thought, hey, what's happening on the inside? What are people seeing on the inside of the business? All the different layers. I mean, we're talking to institutions, we're talking to private investors, we're talking to syndicators, we're talking to LP investors. And those conversations have been really valuable for me. And I think that it can add something for the listeners and investors across the community. So I'm excited for my conversation today with my guest, Ben Lapidus. Ben's the CEO and co-founder of Playground, a condo flex development shop and a principal of Best Ever CRE. Ben's been an active investor and syndicator of self-storage, but the reason Ben's here is because he's a really smart guy and he's on my short list of people that I call when I'm trying to figure something out. So I'm really excited to have Ben here with me today. I'm sure all of the Best Ever listeners will get a lot of value from this conversation. So let's get started. Hey, Ben, welcome to the show. It's great having you on today.
Thanks, John. Super excited to be the first guest on your podcast. As someone who represents Best Ever, is helping build the Best Ever brand, runs the Best Ever conference, I know that the Best Ever listeners have been asking for years for an economic perspective, the kind of economic perspective that you bring to the Best Ever conference every single year. And now it's going to be available digitally for free to the world. And there's really only a small handful of people in the United States who get access to data pipelines in volumes as large as yours, transaction volume as large as yours, and who talk to however many buyers and sellers across every single type of asset class for the purpose of having the most economic information for what lies ahead for the future of real estate. So I know that the Best Ever audience is going to be very excited as this show evolves, and we're happy that you're now part of the podcast lineup.
Ben, what have we seen? One of the things that we want to talk about every week is what we're calling the one thing. The one thing is something we've seen in the media recently that caught our attention, and we really want to dive into it a little bit and share our insights on how that affects the real estate climate. So, Ben, I think you brought something up earlier today when we were chatting, and you had some ideas on a good one thing to talk about.
Yeah, so Green Street recently released an article talking about the change in interest rates and how that's going to affect appreciation going forward. And this was summarized really well in about a 30-second bite-sized chunk in the Best Ever newsletter. If you'd like to receive that newsletter, you can go to bestevercre.com for awesome consolidated insights from the Best Ever team every week. But I thought that article was very interesting because it basically said interest rates have gone down 75 basis points, but don't expect that to increase the value of real estate in the short term anyway. And I thought it missed a couple of key points because while that is correct, it ignores the reality that we've seen in every trend that retail banking rates lag behind the change in the federal funds rate movement. And so ultimately, there will be a change in appreciation and in value. There will be a compression of interest rates, which oftentimes is followed by a compression of cap rates, which then pushes up real estate values. But we need to wait for the competitiveness to enter the retail banking system. Now, that's a quick summary that I'm sure we're going to want to get into, but that's the one thing that I saw this week that was worth bringing up and wanted to dive into and offer a counter perspective.
So interest rates are they're their own beast, right? So there's the Fed rate with the overnight rate, which is basically what banks pay to borrow money overnight from the Federal Reserve, right? That's hence the overnight rate. And then there's the 10-year Treasury, which is which is tied to a 10-year maturity date. That's what most of the lending is based off of. And they have a life of their own. They're not always moving in sync. There's a ton of different forces moving the 10-year Treasury. One of them is the federal funds rate, but as Ben said, there's always a lag, and these things are not moving in tandem. We've seen that really clearly, literally over the last couple of weeks. We had a Fed rate cut in November, and it was right after the election, but the 10-year Treasury has shot up. I mean, it's up 20 basis points in about a week and a half, and it's up 70 basis points, over the last 45 days or so. And that is exactly the opposite of what's happening with the federal funds rate. And then you tie this over into the investment market and what's happening with prices. And, clearly there's a disconnect in there.
Yeah, it's disjointed. Yeah. So what do you see typically, John, when there is a tightening, over the last 4, 5, 6 cycles, when there's a new loosening of interest rates? What do you usually see as a response to the federal funds rate? Is this common, or is this kind of disjointed delta between the 10-year Treasury rate and their federal funds rate movements uncommon?
No, this is normal, right? It's normal for these rates to be moving their own direction at their own pace. There's a lot of questions about the long term, and actually this drops right into something that I swore I was going to avoid today, which is the election. So in the last couple weeks, the day after the election, I was standing in New York City meeting with a whole bunch of institutional investors, and their response to that was going one direction, right? So the New York investors were seeing one thing. A couple days later, I was in Charlotte, and it was a little bit less of an issue. And a couple days after that, I was in Dallas, and the perspective in Dallas was the polar opposite of what I was seeing in New York.
What were those two perspectives in New York and Dallas? I'm so curious.
So in New York, which, as everybody knows, is a blue state, and it's a lot more of the people in the room were more liberal. Their perspective was really tied to, okay, all of these policies that are being talked about on the campaign trail by the Republicans are generally inflationary, or they put upward pressure on rates. Okay. The reason being, and again, you talk about deportation, you talk about what's going on with the immigration, and you look at tariffs, you look at deficit funded tax cuts. Those all put upward pressure on interest rates, and they put upward pressure on inflation. And the people in the room that I was talking to were really focused in on that hard. That was top of mind for them. They were thinking, well, the Fed can't cut rates. Even, a day later on Thursday in November, the Fed can't cut rates because this is going to be really inflationary, and they need to put brakes on it now. Now, when I was in Dallas a couple days later, and these topics came up, the perspective was, well, these may or may not happen. These are negotiating tactics. This is all part of a bigger plan, and that it's not necessarily going to affect inflation. It's not necessarily going to affect interest rates. We're going to see stronger growth. We're going to see more employment. We're going to see more momentum, and that's going to offset it. The value of the dollar is going to go up, and that'll partially offset some of the inflationary pressure from tariffs, and so on. So there were a lot of ideas about different forces coming into play. Price of oil could come down, and that's going to drop energy prices and so on. So the perspectives and what people locked in on were very different, depending on which room I was standing on. And so the perspective on the impact on interest rates was very different. But I did see a comment on LinkedIn from somebody I know, CEO of a company, And he's saying, hey, this, he's obviously a Republican. He's very positive about the outcome of the election. And he said, look, we're just going to have to get used to higher interest rates. That's just the way it is. These are actually normal rates. Historically, we're right on par with the long-term average. And so, it's not really going to have that big of an effect. But Ben, you're an investor. You're out there in the field. You're trying to put deals together. You're an active investor. What do you think? What are you seeing out there?
So I think it's really interesting what you just distinguished between the New York and the Dallas mindset. New York is thinking, well, rates aren't going to come down. In fact, they might go up because the Fed, the central rate, can't be pushed down any farther in downstream consequence of these potential policies. Dallas is thinking rates are coming down eventually, and so therefore retail rates will follow. And so I think there's two components there. Are retail rates going to follow a declining federal funds rate? I would argue yes, because there will be more margin for the banks, more competition will enter the ecosystem. There's more lending appetite than there is borrowing appetite. Rates are going to start coming down in conjunction with the federal funds rate. However, if this New York perspective is correct and the federal funds rate is going to increase over the short term, then the retail rates are not going to follow. And then this Green Street article has something more meaningful to say. I think that there's as an investor, there's a couple of things that I'm looking at. No matter what, I'm always going to underwrite expanding interest rates and expanding cap rates. I'm never going to compress them in my underwriting file, regardless of what's going on in the ecosystem. Maybe I'll start a little bit lower, thinking that cap rates should be a little bit lower compared to where they are in response to what's going on, and cap rates haven't caught up. But I'm always going to underwrite expansion regardless. So as a developer, I'm kind of interest rate agnostic. I need to get in and get out. As a buy and hold person, I need to make sure that my interest rates are not in a negative leverage environment to my net operating income. So I think that there are going to be two considerations. There's the fundamentals of tenant dynamics. If I'm buying storage and I have an inflation hedge in this storage asset because my leases are month to month, and I know that over 2 years I can get a 40% rate increase, then I might be purchasing an asset at an 8% interest rate that is only performing at a 6 cap because I know that I can push the NOI. But that is kind of played out as far as I can tell. That inflation hedge in low in quick lease turns, that play is not as available as it was 2 years ago. There's a lot of pressure on affordability in multifamily that I'm seeing. There's pressure on affordability in car loans, in storage rental rates. And so the other dynamic that's at play is investor supply and demand appetite. And the things that I'm seeing are the Goldman Sachs report that says that the next 10 years is going to be a 3% increase, an annualized increase in equities compared to the last decade of 13%. I'm seeing a record amount of debt in the global report. IMF's last fiscal monitor said that we're going to be breaking 100 trillion in global debt by 2030. And we have a record-breaking 100 trillion for the first time right now of global debt. So there's going to be more borrowed money, of borrowed wealth around the country to invest in real estate. And modern portfolio theory suggests that 35% of your portfolio should be in alternatives, whereas I think right now on average it's like 11 or 12%. All of those things together indicate to me that there's going to be more investment demand for real estate, even if that means lower spreads between interest rates and cap rates, because it's just an opportunity cost question for investors. So I think right now is actually a pretty good time to be getting into commercial real estate. On average, commercial real estate is down 19% from the peak, 37% in office, 21% in storage, according to that same Green Street report. And so interest rates, yeah, I think we gotta make sure that our fundamentals are correct, but there are deals out there. The transaction volume is down now. Marcus and Millichap's gonna be working on that problem. But I think now is a great time to be getting into the commercial real estate game.
Yeah. So you just covered like this giant range on that conversation.
This podcast.
Yeah. I mean, it's like, okay, yeah, 30 minutes. Yeah. Well, we're going to be tight. No. Okay. So first of all, the the idea I didn't hear anybody in New York say they thought interest rates were going to go up. They pretty much said they're going to go down, but they're not going to go down as fast as we thought they would, right? So if you look at Fed Watch, you look at the forward look on the Federal Reserve, you start looking at the movement of rates, and a month and a half ago, 2 months ago, the outlook for the Fed rate was for it to be somewhere around 3.5 to 3.75 by June of 2025. Now, the probability of it hitting 3.75, again, this is according to Fed Watch, which is based on the betting on Wall Street over different bond rates. The odds of it hitting 3.5% is down to like 2%. Nobody thinks it's going to happen. Basically, the probability of rate cuts have been cut way back. Maybe we get 50 more basis points out of the Fed by the middle of next year, and nobody's really looking at the end of next year at this point. There's a lot of questions. Nobody knows about the policies. There's a lot of uncertainty with investors today, right? A month ago, everybody was feeling pretty good. I was talking to investors. They were putting capital out. They were lining up deals. Activity on Marcus and Millichap listings was going up. We were seeing good momentum. But as rates started going back up on the 10-year, as questions and uncertainty about the future of policy came into question, we saw people kind of taking a breather. They're like, wait, I'm not quite sure how this is going to land. And in my opinion, that's almost short-sighted. I mean, you were talking about it, Ben, the time to get active is when the pricing is down, which is where we are today. The time to be active is when other people are hitting the pause button. If they're backing out, you're not competing with 20 or 30 or 40 or 50 people on a deal. If you're the only one standing there, your probability of getting that deal goes way up. And so that allows you to drive the price and terms a little bit better. And I think that the momentum of commercial real estate, especially in light of what you were saying about Goldman and what to expect from the stock market, in their opinion, real estate offers those durable long-term returns. And I think there's fantastic opportunity out there today.
I agree. I think that the opportunity cost of not putting your money in real estate going forward is going to be more costly. And so there will be increased appetite, increased demand for the investment vehicles, which is going to be a driver for increased pricing, regardless of what's going on in net operating income and in interest rates. Now, those other pressure points might have an opposite effect, but that is a consistent positive force for the real estate industry, is an unmet investment demand for real estate investing. So,
well, we've seen a huge transformation over. If you get out, you have to look long term, right? If you look back 20, 30 years, you look at the transaction activity, you look at the number of deals, you look at the dollar volume, and it is dramatically higher today than it was. Even I remember back in 2007, right? We were hitting peaks in commercial real estate. Transaction activity was off the charts. Looking back historically at that point, everybody was like, oh my God, this is like crazy. We're never going to hit this level of investment activity again. And lo and behold, not even 10 years later, in about 2015, 2016, we surpassed that and we went far beyond it. And then in 2021 and 2022, we hit a new high tide mark. And considering, I just proved the 2007 theory wrong. Now people are saying, hey, 21, 22, we're never going to hit that again. The interest rates were almost nothing, and the yields were going up, rents were accelerating, everybody was feeling good about it, all types of commercial real estate except office. But really the momentum was there. And so the capital flowing in through direct investment, right? The old timers are still there. The private investors, they still go out and they buy and sell. You still have the institutions, but the flow of capital coming to real estate has increased substantially, but we're not there yet. It is, as you said, it's like it's less than 11% of the allocations from the institutions. Most people, most high net worth people are not investing in commercial real estate to the level they should. Of course, the stock market's done really well lately, so they're feeling good. Everybody's a genius when the stock market's going up. But when it goes flat, because it's of all those dimensions in that article and that Goldman Sachs study, then you have to start really looking at alternatives. And of course, I favor real estate, but I have lots of built-in advantages. I think that there's just tons of opportunity here. Okay, so Ben, we've gone through all of this stuff, and we've talked about far more things than we planned on talking about, quite frankly. We jumped all over the place. And again, this is actually how our conversations go. And when I'm trying to figure something out, I call up Ben, and this is what happens. But let's talk a little bit about the horizon. We called this podcast The Horizon because every week when I'm sitting down, I'm looking at the news, I'm looking at the media, I'm looking at all the things piling on top of us as investors. I always try to remember, hey, wait, I'm going to buy or sell real estate, and I'm going to have to look a year, 2 years, 5 years, 10 years down the road and figure out where we're going to be there. And so, again, if you see my videos on LinkedIn or some of the other channels or marcusmillichap.com, I always end and say, hey, keep your eyes on the horizon. And that's really the cornerstone of what we're doing here. So we just had this great conversation. We talked about the election. We talked about whether or not now is a good time to buy real estate. We talked about interest rates, what they're going to do. We talked about the returns on the stock market. Let's put a bow on this and let's focus out 5 years. Where does all this stuff take us if we invest today? And what's the outlook over the longer term? What do you think?
I think the outlook over the longer term in commercial real estate is more attractive than almost anywhere else. I mean, there are industries that form that are nascent. And if you can invest across all of the players in that industry as like a venture capitalist, let's say, as it matures, that's always going to be better returns. But it's risky, it's non-collateralized, it's inconsistent. And I think the same next cycle of commercial real estate is going to be the same as the last 12, 13 cycles, the last 100 years. You look at the last 100 years of real estate, you've got a 2-3% annual performance in excess of the of inflation. It is an attractive, consistent player, and there's a reason why the majority of millionaires have real estate in their portfolio, and the majority of millionaires made their first million with real estate. So it is a consistent, collateralized way to build net worth, build potential cash flow for yourself and for others. And the fundamentals, the investment fundamentals, like we talked about in that last conversation, is there. There is opportunity cost in investing in equities that has a predicted annual return of 3%. There's an opportunity cost of not having a balanced portfolio in alternatives. There's an opportunity cost of not having your hands in kind of every sector. And real estate is one of the most fundamental sectors for the human experience: water, food, shelter, right? So shelter is an important component of being able to survive and execute collective action amongst our species. So shelter is an important aspect of society. So my outlook on commercial real estate as a whole, without breaking down the different sectors, is really attractive. Now, inside of commercial real estate, what's your investment thesis? What's your play? I think commercial real estate is starting to look a little bit more, not a lot, but a little bit more like high frequency trading dark pools. There is an immense amount of data, especially first party data, amongst the REITs. And there are business intelligence departments that allow them to outcompete the mom and pop player. So finding niche approaches, niche investment execution, I think is important for the retail investor, the mom and pop investor. But I think holistically, the entire asset class is going to be a rising tide.
One of the other things, and again, circling back to that article out of Green Street, where they say values are down 19%, and it varies by property type, it varies by market, it's all over the map, right? But the thing is, generally speaking, you look back over the history of real estate, it doesn't go down in value very often. It is actually fairly rare. The last time we saw a downturn, we saw a little in some sectors. We saw some during the pandemic. We saw some actually a broad-based downturn during the financial crisis. But, over the last 20 years, it's rare. So I was talking to one investor and they said, look, real estate is on sale right now. It's 20% off. Right? It doesn't do that very often. It doesn't go on sale very often. Let's go out and we're going to buy some more. We're putting together our capital and so on. But it's really a strong thesis. You mentioned something just a moment ago. I want to resurface that. And you said, hey, the institutions have all these really smart people, but they do also have some challenges. They have access to better information, generally speaking. They have access to really smart people. And I'm going to have some of them on the show. I'm not going to say who yet because we're still working out some details, but I have some really well-known people in the industry from some of the top institutional investors who are scheduled to be in here with me. And they have challenges just like everybody else. They have investment committees. I was talking to somebody and he's like, man, I'm working on some stuff and I had to go through a compliance department. And, the small private investor, even the syndicator, they don't have an investment committee a lot of the time. They don't have a compliance department. They don't have to go through all the bureaucracy and the hoops and hurdles to get a deal done. And so they have built-in advantages on one side, and the institutions have way more capital, generally lower cost capital, and they have a lot of different things that they're able to do. So each group of investors have unique advantages that they're trying to bring to play in the market. And that's what actually makes my job so interesting.
Yeah. And that's true. It's really important to highlight those pros and cons of the different avatars out there, because every single person can figure out how to be successful in this game. The only thing I caution is having a non-unique approach to your investment thesis, because what makes it easier to get through compliance if you're an investment committee is a rinse, wash, repeat deal. We've done this before. It's made us money. Here's another one. It's right down the aisle there, whatever the saying is.
Right down the fairway.
Right down the fairway. Thank you, sir. Right down the fairway. And so if you are attacking that deal as a mom and pop investor or as a retail syndicator, you're competing with the institution where that deal is right down their fairway, there's a good chance their cheaper cost of capital is going to outcompete you. So, but yes, you're right. There's pros and cons in every avatar, and it is a cauldron of experimentation that is a lot of fun to operate in, which is why you and I have so much fun.
All right. So I think we could put a pin in it. I think we've covered a lot of things. Thanks, Ben. It's been great chatting with you this week.
Thanks for having me, John.
All right. Thank you, Ben. And thank you, best ever listeners, for joining me today for my show, The Horizon with John Chang. I'll be back next Tuesday and every Tuesday with other fantastic guests and real estate insights to help you understand what's really going on in the real estate world. So I'll see you next week. And as always, keep your eyes on the horizon.